Good evening, everyone. How are we all? Good evening. Can you hear me, guys? Yep. Good evening. Good evening, Manjari. I hope you can hear me and also be able to look at me and the screen. Correct? Okay, so we were into the chapter of capital structure, and we were discussing about the ways to select a particular capital structure plan. Whether we should go for a fully equity or some equity, some debt, some sort of debt or preference share. So we're looking at multiple plans to choose from when we wanted to decide which plan should be selecting. So when we wanted to decide which plan we should be choosing to raise funds, we were looking at these certain numbers. And what was the criteria, by the way, guys? What was the criteria on the basis of which we were selecting the plans? What was the criteria? Were we selecting the plans based on earnings per share, or were we selecting it based on market price per share, or how was it? What were we really looking at when we were deciding the selection? We were obviously looking at the plan which results in highest EPS, and if the question gives you information about the highest NPS, I mean, if it gives you the information about the P ratio, price to earning ratio, that is where you can say that the plan with highest P ratio, or sorry, highest market price per share was to be selected. Now, in this topic, we have also discussed about something called as financial break-even point and indifference point. Right? So, financial break-even point was the level of EBIT at which your EPS was equal to 0. And indifference point was the level of EBIT at which two plans were having equal EPS. Right? Two plans were having equal EPS. Right? So these were the two concepts that we have done yesterday. And we also said that the plan with higher break-even point is supposed to be more riskier than the plan with lesser break-even point, because the plan which is having a lesser break-even point will have greater capability to recover. I mean, we will have greater ease to reach the profit area. Then we have also seen the indifference point, financial indifference point. Now, that financial indifference point was actually telling us at what level of sales EPS of both plans were equal. Moreover, apart from that, it was also telling us what should be the decision if your expected EBIT level is above the indifference point or below the indifference point. If your expected EBIT is above indifference point, then you should go for a riskier plan. And if it is below that, then you should go for a less risky plan. Okay. Now we are here in this chapter, capital structure, to the next part, which is capital structure theory. In capital structure theory, we are going to look at a debate that is ongoing between two set of economists, between two set of financial economists. There's a debate which is ongoing since long. Right? Now, what is that debate really about? So if I tell you that there is a company called as XYZ Limited, right, which was having some capital structure. Okay, so let's say it was having equity share capital of 5 lakh, and it also had reserves amounting to, let's say, 3 lakh. Right. So we said that total capital employed is 8 lakhs. The total capital employed is 8 lakhs. Now, suppose this same XYZ Limited, company, it says that let's go for buying back few of the shares. It just goes ahead with buying back some of the shares. So let's say out of 5 lakh, it buys back shares worth 1 lakh, and reserves also get reduced by 1 lakh. Okay. And then you have a debt coming in of 2 lakh into the business. Now the capital employed is still 8 lakhs, but the structure has changed. Earlier, it was fully funded by equity. Earlier, XYZ Limited was fully funded by equity. Now, XYZ Limited is having some sort of debt in its capital structure. So, XYZ Limited, earlier it was fully funded by equity. There was no loan in the company. But now, in this case, XYZ, there is a loan which is there in the company. Now, what do you think? Value of business. Value of business of the company before going for debt and value of company after going for debt. Is it going to be same or is it going to be different? What do you think? Is the value of the company before borrowing and after borrowing, is it going to be equal or is it going to be different? What do you think? What should be the situation? Is the value of company going to be same or is it going to be different? Should be different? Should be different? Well, that is where the debate is lying. Well, some of them are saying that value is going to remain same, and some in economists are saying that value is going to be different, right? So those people who are saying that value of both the companies are going to be same, they are said to be following, or they are said to be looking at theories. They are said to be in totality called as theories of irrelevance. And this one, when we are assuming that the value is going to be different, then we are saying that we are following theories of relevance. Then we are saying we are following the theories of relevance. So what do you mean by theories of irrelevance? Theories of irrelevance means value of both the companies is going to be same, irrespective. Value of both companies is going to be same, irrespective of the amount of debt that you have. So whether a company has a debt or it doesn't have any debt, the value depends on the business and not on the capital structure. So therefore, we say value is going to be same. The capital structure is actually irrelevant. When you say both companies are different, the value is going to be different. Then you say that their capital structure is relevant. Capital structure is a deciding factor for the value. And that's where we say that value of business is going to be different. Okay, so we are going to learn two set of theories. First, let's look at what are the theories that we are going to look at. Theories of relevance. And we also have theories of irrelevance. Now, theories of relevance consist of certain theories like net income approach,
10,000
or theories of irrelevance. Theories of relevance will have one thing is net income approach. Another would be like traditional theory. Okay. And in the theories of relevance, we'll also have Modigliani, Miller with the taxes model. Theories of irrelevance will consist of certain theories like net operating income approach, right? Then you have Modigliani, Miller, arbitrage approach. Right? So these are the 5 theories that we are going to look at. So 5 theories are net income approach, traditional theory, Modigliani, Miller with taxes. Theories of irrelevance will be net operating income approach, Modigliani, Miller, arbitrage approach. Okay. I hope the base of the chapter is clear right now. I hope we are discussing, we are clear what we are really discussing. So these 3 theories are essentially telling us that theories of relevance. It means they're saying that theories of relevance, it means they're saying that if a company is having debt, it will have different value as compared to the company which doesn't have debt. And theories of irrelevance, they say that companies having debt or companies not having debt, it's not at all, it doesn't matter because it's going to be one and the same. So when you say theories of irrelevance, it means the company having debt and a company having no debt will be having the same value. Okay, so both companies are going to have the same value. When you say that, that is essentially you're looking at the theories of irrelevance. Okay. Are we good with the basics of the chapter, guys? The base of the chapter is clear. We're going to discuss these 5 theories, but I hope it's clear, understood right now what we are going to discuss. Okay, great. Now let's get started with something called as net income approach. Okay, net income approach. Was it a theory of relevance, theory of irrelevance? Net income approach, was it a theory of relevance or was it a theory of irrelevance? Yeah, guys, tell me. Net income approach was a theory of relevance. It means the conclusion should be that value is going to be different. Right? The conclusion is going to be that value is going to be different for different level of debt. Like if a company is having debt, the value is going to be different as compared to company not having debt. Okay. Now, how do they really prove it? How do they really prove this particular point? So let's have a look at it. First point in net income approach, first point we say is cost of debt is less than cost of equity. Do you agree with this first point which net income approach is putting up? Do you agree with this the first point? Do we agree that cost of debt is going to be less than cost of equity? Yes. Why cost of debt is going to be less than cost of equity? Since cost of debt is going to be less than cost of equity, since debt fund providers undertake lesser risk as compared to equity. Since debt fund providers, so we can say debt fund providers undertake lesser risk as compared to equity, right? Okay, so that's the first point. Then the second point that they say is, as company finances more of its business by debt, its KO, which is the weighted average cost of capital, will reduce. Right? As a company finances more of its business by debt, its KO, or weighted average cost of capital, is going to reduce. Now, is this really going to happen? Yes, that's really going to happen. So let's have a look at it. So for example, let's say the value of equity, the value of debt. So initially, full 10,000 was with equity shareholders. There was no debt. Can you tell me what will be the weightage of equity and weightage of debt in this scenario? If equity is 10,000 and there's no debt, what can you say about the weightage of debt and weightage of equity? Is the weightage of debt and weightage of equity going to be same? Is the weightage of debt and weightage of equity going to be same, or is it going to be different? Yeah. If equity is 10,000 and debt is 0, what is going to be the weightage of debt and equity? Can you say weightage of equity will be 1 and weightage of debt will be 0? Correct? So if you have equity investment of 10,000 and debt is 0, weightage of equity is 1, weightage of debt is going to be 0. And now if I ask you what is cost of equity, cost of debt, K is, let's say, 15% and KD is, let's say, 10%. Cost of equity is suppose 15%, cost of debt is, let's say, 10%. How do we calculate weighted average cost of capital? Can anyone tell me how to calculate the weighted average cost of capital here? How is the weighted average cost of capital calculated? How is the weighted average cost of capital calculated? Can I say it's going to be weightage of equity multiplied by cost of equity plus weightage of debt multiplied by cost of debt. Weightage of equity multiplied by cost of equity plus weightage of debt into cost of debt. Right? So that's going to be like 1 into cost of equity plus 0 into cost of debt, which is 10%. So right now, what we observe is it is going to be 10%. Now, let's say in subsequent stages, the company says, let us buy back some of the shares. The company says, let us buy back some of the shares. And instead of that, let's borrow something. So let's say company buys back 1,000 of equity. Suppose company buys back 1,000 of equity with debt. So let's say it borrows 1,000 and returns that 1,000 money to the equity shareholders. So you have now 9,000 equity left along with a debt outstanding of 1,000. Can you tell me what will be the weightage of equity and weightage of debt now? What will be the weightage of equity and weightage of debt now? Yeah. Perfect. So its weightage of equity is 0.9 and this is 0.1. So cost of debt and cost of equity is also this. Now suppose you go for more level of taking more debt. So let's say you go for 8,000, then this may be 7,000, maybe 5,000, and maybe 2,000. So you have like the value of debt is simply 10,000 minus the equity amount, right? And then can you calculate weightage of equity, weightage of debt, cost of equity, cost of debt for the remaining values? I'll just give you a couple of minutes. Try to calculate these ratios. I mean, not ratios. Try to calculate these weightages. Calculate the weightage and also get the, the cost of equity and cost of debt is going to be same. But get the weighted average cost of capital, guys. Just have a look what is happening to weighted average cost of capital. Calculate the cost of weighted average cost of capital, guys. Cost of equity and debt is given. You just need to calculate the weightage and get the weighted average cost of capital. So this is going to be like 8,000 divided by 10,000. So these are the weightage of equity. Weightage of debt will be these numbers. Can I say weightage of debt is increasing? What is happening to the weighted average cost of capital? Do we observe that weighted average cost of capital is reducing? Yes, 14.5, 14, 13.5, 12.5, 11. Yes, the weighted average cost of capital is getting reduced, right? Right? Okay. So weighted average cost of capital is getting reduced. That's the second point. Now, the third point which they say is, they're saying as KO, which is the weighted average cost of capital, reduces, value of business or value of the firm increases. Now, how is this happening? For that, let's try to understand how do we get the value of business, equity, and also debt. Now, if I ask you, we want to value a particular business, how do we go about valuing a business? Yeah, guys, tell me. How are we going to value a particular business? How are we going to value a particular business? Suppose you want to value a particular business, how do we go about value? Yeah. How do you determine the value of a business? How to determine the value of a business? How do you calculate? Total of wealth. How do you get that total of wealth? How to get that total of wealth? When you're saying that we want to value a particular business, what is the method by which we can value a particular business? Let's say I want to buy, one of the shops. Okay, let's say I want to buy one of the shops as a running business. How do I determine how much amount I should pay? How do I really work on the amount that I should pay, to the owner to get control over that business? So it is debt plus equity plus reserve. So value of capital structure, that is company funds. So all of you are saying like whatever is there in the books, the assets. Simply take a look at those assets and try to calculate the value of all those assets. Subtract the liabilities. That will give you the value of the business, right? But that's not exactly how a business is valued. Always remember, value of any asset in finance. Always remember this thumb rule. Any asset we want to value in finance, it's not going to be based on what the value is written in the books. What is the value that you observe in the market? What is the value which you will, which you are looking for? Nothing. Value is going to be determined as present value of future cash flows. Simple. It's always going to be present value of the future cash flow that you're going to get from a business. So when you want to value a particular business, you can value it by simply looking at what is the present value of the future cash flows. Right? So if you want to value anything, it's going to be present value of future cash flows. Like for example, if I ask you, what is value of equity shares? Can you tell me what is the cash flow that you get from equity shares? What is the cash flow that you get from the equity shares? What is the cash flow that you get from equity shares? As an equity investor, what cash flow do you get from equity shares? What is the cash flow that you're going to get? Dividend, right? So it's going to be present value of future dividends. The value of equity shares is simply present value of future dividends. Right? Same way, value of debentures. What cash flows do you get from debentures? You obviously get present value of future interest plus present value of future principal, right? Correct. Right. So this is like value of debentures. It's going to be present value of future interest plus present value of future principal. That's the value of debentures. Same way, if you want to value any particular asset, you just need to take the present value of future cash flows. So same way, if I want to value the business, or if I want to value, let's say, equity. If you want to if you want to obtain the value of equity, that is simply going to present value of future profit after tax. Assuming that whatever profit is earned, that is going to be dividend, that is going to be paid out, because whatever profit after tax is being earned by the company, that is actually to be paid for, that is actually going to be paid to the equity shareholders. Right, guys? Just a moment, guys. Yeah, guys. So, value of equity will be like present value of all the future profit after tax that you're going to get. Can you hear me now, guys? Yes. Okay. Just wait. Let me join back again.
Recording in progress.
अशोक जी, मेरे दूसरे डिवाइस को पोस्ट बना दीजिए, स्क्रीन शेयर करना है. निकल गया था ना वहां से. थैंक यू. Okay. So value of equity, since we said value of equity is going to be present value of all future profit after tax. So future profit after tax will be like PAT for first year upon 1 plus K plus PAT for second year upon 1 plus K square plus PAT for third year upon 1 plus K to the whole cube, right? So your profit after tax, each of the year profit after tax is getting discounted to current value terms, right? So we're just getting the values discounted, right? So because we know that amount is equal to principal into 1 plus I raised to n, right? So that again simply implies principal is equal to amount divided by 1 plus I raised to n, right? So assuming that all PAT are going to be same, if you're assuming that PAT for first year, PAT for second year, PAT for third year, all are equal, if you assume that way, we can definitely say that since all PAT are equal, we can say PAT 1, PAT 2, PAT 3, all are equal. So we say PAT every all run, right? Now this is going to be taken till perpetuity. Does it seem like some series to you? Some mathematical series to you? Does this seem like some mathematical series to you guys? Does this series looks like some mathematical series to you? Hmm? What series does it look like to you? Yep, geometric progression, right? So when you apply the geometric progression formula, because this goes on till perpetuity, so summation till infinity, the formula is a upon 1 minus r. Over here this is a, so a is like, you know, pat upon 1 plus k, right? So over here a is pat upon 1 plus k and r the multiple is 1 upon 1 plus k. So when you apply that geometric progression formula over here, you can say a is pat upon 1 plus k, the whole divided by 1 minus 1 upon 1 plus k. And then when you say it is pat upon 1 plus k, the whole divided by 1 plus k minus 1 upon 1 plus k. this gets cancelled, and we are left with just PAT upon KE. So this entire sum can be simply stated to be like PAT upon just KE. So that's where we get this formula for value of equity. So value of equity is calculated as profit after tax upon cost of equity. So value of equity is going to be calculated as profit after tax upon cost of equity. Okay. Now, similarly, if I ask you what should be the value of debt, what should be the value of debt? Value of debt is going to be interest upon cost of debt. And then value of firm, or the value of business is going to be EBIT upon KO. Right. So these are the formula that we need to really remember. These are the very basic formula that we need to, keep it in our mind. Value of equity will be PAT upon KE. Value of debt will be interest upon KD, and value of firm will be EBIT upon KO. Okay. So value of firm is EBIT upon KO. Value of debt is interest upon KD. Value of equity is PAT upon KE. One more formula that we need to look at is value of firm will be value of equity plus value of debt. Value of firm will be equal to value of equity plus value of debt. All these four formulae, are we clear about, guys? All these four formulae are based on the simple fundamental of value of anything is simply going to be present value of the future cash flows. Everything is going to be on the lines of present value of future cash flows. Are we clear with this all four formulae, guys? KO means overall cost of capital, weighted average cost of capital. Sunil, KO means weighted average cost of capital. So when you're looking at entire business value, you're obviously going to take the overall cost of the capital. Okay. Okay. So now let's come back to this particular thing. They were saying that as KO reduces, the value of the business or the firm is going to increase. They're saying as the KO reduces, value of the business or the firm is going to increase. So let us say EBIT and KO, and then value of firm being equal to EBIT upon KO. So let's say EBIT is let's say 2000, and we have multiple KOs available like 15%, 14.5, 14, 13.5, 12.5, 11. Can you just see what is the value of firm over here? And look at the trend that you observe in the value of the firm. Yeah. Let's try to get the value of the firm over here, guys, simply using the formula of EBIT upon KO. And let me know what is the pattern, what's the trend that is going on over there. What do you observe? What's happening to the value of the firm when you calculate the value of the firm at multiple levels of KO? Is it increasing or decreasing? Is the value of the firm increasing or decreasing? Value of the firm is increasing, right? So because when you do this 2000 divided by KO, right? So when you do divided by KO, what is it really happening? Can I say the value of the firm is increasing? So in conclusion, can we say as company takes more debt, its value increases. As company takes more debt, its value increases. Can we say that? Yes or no? Correct. So is the capital structure having an impact on the value of the company? Yes, definitely it is having the impact on the value of the company, right? So as the company takes more debt, we observe that the value of the company is increasing, right? But then, of course, in this particular concept, there is one shortcoming, guys. There's one shortcoming. Can I identify what is the shortcoming? What is the problem in this theory? While everything was explained, there is some problem or there is some shortcoming in this particular concept. It's okay that we observe the value of the firm is increasing with a with a weighted average cost of capital, but when we are looking at value of the firm, it's like increasing, but there is some shortcoming in this particular concept or in this particular theory. Can I identify what is that shortcoming? Can I identify that shortcoming which is there? Yeah. Can I identify the shortcoming? No. Well, the shortcoming is regards to cost of equity. Now, as Julie properly mentioned, that taking more debt puts more interest burden. And now, when there is a higher interest burden, what happens with the risk that equity shareholders were facing? With higher amount of interest payable, with higher amount of interest payable, what do you think? I mean, with the higher amount of interest payable, what do you think is happening to the equity shareholders' risk? Can I say equity shareholders are facing more risk? Like when the company didn't have any debt, they were facing some amount of risk. But now when the company is having a debt, they are facing a greater amount of risk, right? So as they're facing more amount of risk, will they be asking for same 15% rate of return or more than 15% rate of return? Will they be asking for same 15% rate of return or more than rate of return? More, right? So that's where we have this net next approach called as the net operating income approach. So that's where we are looking at the net operating income approach. So now net operating income approach also, they say that first point is absolutely bang on. That's very much correct. That cost of debt is less than cost of equity. But the second point they say, as weightage of debt increases, right? As weightage of debt increases, right? What is going to happen with the, as the weightage of debt increases, what is going to happen with the um, uh, overall cost of capital? We'll say KO reduces, but as the weightage of debt increases, there is a side effect coming in. What is that side effect of higher amount of debt? What will be the side effect of higher amount of debt? As weightage of debt increases, side effect will be K will increase due to higher debt, right? And as K increases due to higher debt, KO will rise. So the KO which was earlier reducing, now it will start rising, and the cumulative effect of both is going to be like KO remains constant. Right? So as weightage of debt increases, KO reduces. Side effect is that K will increase due to higher debt, KO will rise, and then obviously we say that the KO is going to remain constant. So as the equity shareholders are facing higher risk, they will ask for a higher rate of return, and obviously KO is going to remain constant. So let me just portray this to you. cost of equity, cost of debt, and then weighted average cost of equity will, weighted average cost of capital will be weight of equity into cost of equity plus weight of debt into cost of debt. Okay, so KE, obviously the KD was remaining to be like 10%. Let me just remove this particular portion, the first portion. Over here, K was 15% for a smaller amount of debt of 10%. So that was giving us a weighted average cost of capital of this equal to 15% divided by 15% uh, multiplied by 0.9 plus 10% multiplied by 0.1. So that's like weighted average cost of capital is 14.5%. Weighted average cost of capital is 14.5%. Now I'll just give you some K numbers which will ensure that the weighted average cost of capital remains same as 14.5%. We can say 14.5%. 14.5% minus divided by this. Yeah. So you can just see as the debt amount increases, equity shareholders require higher return, and therefore the rate of return that they need is also rising. It increases from 15% to 15.63, further to 16.43, further to 90, and further to 32.5. Just try to calculate this weighted average cost of capital numbers, guys, and check what is happening. Just try to add up these numbers and just check what's happening. What is the case with weighted average cost of capital? Just check what is happening with the weighted average cost of capital. For this particular KE, is the overall cost of capital remaining constant? Let's try to calculate and see. So we are simply following the premise that K is going to rise with the increase in weightage. Is it remaining constant? Can you see it's remaining constant at 14.5%? Right? Now it's quite obvious that as KO is constant, what will happen to value of firm? Value of firm will also be constant. Correct, guys? So as the weightage of debt increases, KO reduces, but on the other side, KE also start rising, which pushes an upward pressure on the KO. This ensures that your KO remains constant, and then as the KO is constant, value of the firm is also going to remain constant only. Right? So we simply identified one shortcoming or one mistake in the weighted average, in the net income approach, and we just try to change it so that we are able to reach a particular weighted average cost of capital, and that ensures that your weighted average cost of capital remains same. Yep. Are we good with this, everyone? Is the net operating income approach clear to everyone? Yes. Okay. Then we have another theory called as traditional theory. This I can explain you with the help of a diagram easily. Okay. Let me just put up a diagram in front of you. So this is representing debt proportion, right? And y-axis is representing the cost. So we're going to divide this entire discussion into 3 stages. This is stage 1, stage 2, and stage 3. Okay. So initially, when we are talking of cost of capital, this is what your cost of equity is. This is your cost of equity. This is your cost of debt. And as you take more and more debt, overall cost of capital is going to rise. So they simply say, this traditional theory says that if the company takes some smaller amount of debt, if the company is taking some smaller amount of debt, it doesn't have any impact on the cost of equity. Because if the company is having a smaller amount of debt, that is absolutely acceptable. There's no problem in that, because some small amount of debt the company can definitely take over a period of time. So smaller amount of debt taken, KO is going to reduce because there is no impact on cost of equity, neither on the cost of debt. So overall cost of capital reduces. Okay. So the overall cost of capital reduces with in the traditional theory for smaller amount of debt. But this is applicable for only to some extent. Beyond this particular level, beyond this particular level, now equity shareholders will be like, let's say if the total capital of the company is, let's say, worth 100 crores. Out of that 100 crores, if the company is borrowing maybe, let's say, 5 lakh, 10 lakh, 20 lakh, 30 lakh, that's acceptable because that's a part of day-to-day operations. So some smaller amount of debt is acceptable. Cost of equity is not going to rise, as equity shareholders are not going to ask for higher rate of return. But when the company crosses a threshold that beyond which now the equity shareholders start facing the risk, and that's where the KE starts rising. And as KE starts rising, your KD being constant, can you tell me what should be the situation happening with KO? What will happen to KO? As KE rises, but cost of debt is remaining constant, what do you think? What's going to happen to KO? What is going to happen to KO? Yeah. What is going to happen to overall cost of capital, KO? What is going to happen to KO? KO will more or less going to remain constant. KO is going to be like more or less remaining constant, right? For a simple reason, KO is going to be constant because there is an upward pressure on KE, and there is a downward pressure due to KD. So KO is going to remain constant. But again, a new threshold will come wherein the bankers are now not ready to lend you at a lower rate. Because if you continue borrowing, do you think if you just keep on continue borrowing, do you think that debenture holders or bankers will give you loan at the same rate at which they were giving you earlier? Do you think the bankers are going to give you the loan at the same rate at which they were giving you earlier? Are they going to give you the same rate, or are they going to charge you a higher rate of interest? If you borrow a larger amount of money, do you expect them to be providing you, a higher rate of return? Do you expect them to be asking for a greater rate of interest or no? Yes or no? Will they be asking for a higher rate of interest? Of course, yes. And as the KD rises, guys, can you tell me what will happen to KO? The KO, which was initially falling, it became constant. Now, after this point, when the debenture holders have also started asking for a higher rate of return, what do you expect KO to be happening? What do you expect to be happening with KO? Can I say the KO is also going to rise? The KO is also going to rise, right? So out of these 3 phases, this is your first phase, this is the second phase, this is the third phase. Out of these 3 phases, which one do you think out of these three phases, which one do you think is the best phase for the company? It is the second phase. The second phase is the best phase for the company. Okay, the second phase is the best phase for the company because that is a phase where your cost of capital is lowest. That is a phase or area where the cost of capital is the lowest, guys. Right, so this is our traditional theory where we are not following any typical approach that this is going to happen or that is going to happen. We're simply saying that the cost of capital is going to be increasing or decreasing depending on the stage in which you are. Right, so it depends on the stage where you are. That's going to determine whether the cost of capital is going to increase or decrease. Okay, so that's where the traditional theory comes to an end. Right, so I hope the three theories are clear. First one is the net income approach, then we had net operating income approach, and then we had this traditional theory. Shall we go for the next theory? Shall we go for the next theory, guys? Yes. Shall we go for the next theory? You said phase 1 KO reduces and phase 2 KO is constant. Then how come it is the lowest in phase 2? KO is constant. So after falling, it is constant at the second phase, right? Shivam. After falling, the KO is constant in the second phase. So that is the lowest because it has been continuously falling. So it becomes constant. It becomes constant at this level and then again starts rising from here. Got it? Theory as well as we'll have questions also, but just I'm covering four theories. One theory will do it by way of numericals, but these four theories are theoretical, so I'm just covering that. And now let's go for one more last theory, before after which we'll be starting with the numerical solving. Now, in this particular theory, we have something called as with taxes approach. So we are talking of Modigliani Miller approach with taxes. Okay, Modigliani Miller approach with taxes. Now, how is it different? This is similar to like net income with taxes. Achha. Under the net income approach, okay, under the net income approach, what were we stating about the values of the two firms? What was our conclusion about value of the two firms? Under net income approach, was the value of the company with debt and the value of company without debt, was it equal or was it same? Under the net income approach, guys. Net income approach. In the net income approach, what was our conclusion? Value of company with debt and value of company without debt. Were they equal or were they different? Were they equal or were they different? Value of companies, I mean value of levered and unlevered company, were they equal or were they different? They were equal, na? Net income approach. Sorry, net income approach, they were different. I wrote it wrong, guys. Sorry. This is net operating. What was happening in net operating income approach? Under net operating income approach, value of a company with debt and value of a company without debt, were they different or were they equal? They were equal, right? In case of net operating income approach, can I say value of both companies were one and the same? Correct, guys? So when it was without taxes, NOI, we said value of a loan company and value of a unloaned company, or value of a levered company and value of unlevered company were equal, right?
value of both levered and unlevered firms were equal. Value of both levered and unlevered firms were equal, right? But when we have with taxes, the system is going to be a bit different. When you have like with taxes, the system is going to be a bit different. How is it going to be a bit different? Listen. You have, let's say, EBIT. One of the firms is, let's say, talk of unlevered, and another is a levered firm. Okay, so EBIT of an unlevered firm is, let's say, 20,000, and even for levered firm it is 20,000. From this you're going to pay interest. Let's say you're going to pay interest of 8,000. Sorry, unlevered is definitely not going to pay any interest, but levered you're going to pay, let's say, 8,000 interest. So we have profit before tax of 20,000 and 12,000. Less taxes, let's say at the rate of 30%. So 20,000 into 30% is 6,000. 12,000 into 30% is 3,600. So profit after tax is 14,000, and this is like 8,400. Okay. In case of unlevered firm, what is the distribution to capital providers or distribution to investors? So PAT is like 14,000. So if we say, what is the distribution being made to the investors? Levered and unlevered. Levered means the company with the debt. Unlevered means the company without a debt. Levered means a company with debt, and unlevered means a company without any debt. So if I talk of distribution to investors, how much money has unlevered company distributed to the investors? Only the PAT, which is 14,000, because there's no interest payment. But in case of levered firm, the company has actually paid 8,000 to debenture holders and 8,400 to 8,400 to the equity shareholders. So total distribution is 16,400. So can you tell me which of these two companies are distributing a higher amount to their investors? Which of these two companies are distributing a higher amount to their investors? Can I say levered firm? Levered firm distribution to investors is higher. So because of this, can you tell me which company should ideally be having a higher value? Which company should be having a higher value? Which company should be having a higher value? Tell me. If the levered firm is distributing a higher amount to the investors, which company should have a higher value, the levered firm or the unlevered firm? The levered firm, right? So therefore, here we say, whenever there is a tax applicable, we say value of levered is going to be value of unlevered. Value of levered is going to be always greater than value of unlevered. Or to put it way like this, value of levered will be equal to value of unlevered plus present value of additional distributions. So value of levered plus, equal to unlevered, but we say that value of levered will be same as unlevered, plus in addition to that we'll have present value of additional distributions to investors. Right? So value of unlevered is going to be as it is. Now what is the additional distribution that is being made? Additional distribution, if you observe over here, additional distribution that was done was 2400. Additional distribution that was done was 2400. So it's going to be present value of 2400. Now, where did we get this 2400? This 2400 was actually 8000 multiplied by 30%, which is 2400. So it's going to be present value of 2400. So which is nothing but present value of interest into tax rate. Because you observe this particular 2400 is arrived at 8000. On that you multiply 30% in tax rate. So this is nothing but value of unlevered plus interest into tax upon KD, and that's nothing but value of unlevered plus this particular thing is called as value of debt into tax rate, or to put it way, the final formula for levered form is going to be value of unlevered plus value of debt into tax rate. So value of levered will be value of unlevered plus value of debt into tax rate. Okay. So value of levered will be equal to value of unlevered plus value of debt into tax rate. Okay, so that is a Modigliani-Miller approach with the taxes. So when we're talking about Modigliani-Miller approach with taxes, it's going to be like this. Value of levered will be unlevered plus something extra. Now that something extra is simply value of unlevered plus the something extra is value of debt into tax, because that represents the present value of all future additional cash flow which the investor is going to have. So this value of debt into tax rate, it indicates the present value of all the additional future benefits that you're going to get. So this is I can simply present it like this. Since this is interest into tax, to make it a first year present value, it will be upon 1 plus KD. So second year amount will be interest into tax upon 1 plus KD square plus interest into tax upon 1 plus KD cube, and this goes on, right? Again, this is like summation till infinity, which is a upon 1 minus r, where a is interest into tax upon 1 plus kd, and common multiple that's getting multiplied is 1 upon 1 plus kd. So if I just substitute over here, we can say a is interest into tax upon 1 plus kd, the whole upon 1 minus 1 upon 1 plus kd. So this is interest into tax upon 1 plus kd, the whole divided by 1 plus kd minus 1 upon 1 plus kd. So 1 plus kd, 1 plus kd gets cancelled, and we have like interest into tax upon kd, and we know that interest upon kd is value of debt. So that's like value of debt into tax rate. Okay, so this is how we compute the value of a levered form from the value of unlevered form. Okay, so now we have done like net income approach, net operating income approach, traditional approach, and net operating income with taxes, or with the taxes model. We're left with just one more model, but before that, we will obviously be doing some sort of numerical questions. Okay, so numerical questions is what we'll do based on these four models. And then fifth model will be again based on numerical values only. We will be undertaking what is the value of levered and unlevered things. Okay, so I think we should be okay with a break right now. Let's take a break of 10-15 minutes, guys, and then post that we will start with the numerical questions on these capital structure theories. Okay, let's take a break, guys. Okay, guys. So we have done all the four concepts. I mean, four theories. Let's now just look at what we have as certain questions to solve. Let me just show you some of the questions before we start. Yeah. So this is the question. We have the class of problems. Yeah. Capital structure theories. One second, guys. Let me just. I just need to find that file for you. Just give me a moment. Yeah, I got the file. So let's look at this typical question, guys. So here we have the Blue Limited. So Blue Limited is an all equity financed company. It is considering the repurchase of 275 lakh equity shares and to replace it with 15% debentures of the same amount. So we are going to buy back 275 lakh worth of shares and we are going to replace that with 15% debentures of the same amount. Current market value of the company is 1750 lakhs. Okay, since it is fully equity financed, since the company is fully equity financed, this value is the value of equity and itself is the value of firm also. Cost of capital is 12%, is 20%. This is basically your cost of equity. The company's earnings before interest and taxes are expected to remain constant in future years. The company also has a policy of distributing its entire earnings as dividends. So the company is having a policy of distributing entire earnings as dividend. Assuming corporate tax rate is 30%, you are required to calculate the impact on following on account of change in capital structure as per approach: market value of the firm, overall cost of capital, and cost of equity. Okay, so first we will talk of being a unlevered entity, and then when it is going to become a levered entity, what is the situation going to be? Okay, under this unlevered entity, being a levered entity, we can say the company had a value of equity as 1750. Then you add the value of debt, value of firm. There was no debt since it was an unlevered entity. Now the value of firm will be obviously addition of both, which is 1750 plus 0. That's 1750. Okay. Now we want to make this company a levered entity by repurchasing 275 lakhs. So 275 lakhs is basically going to be the value of debt. We don't know what is the value of equity. We don't know also what is the value of the firm in this case. Okay. Now, cost of debt, or rather I'll say cost of equity. When we were an unlevered firm, the cost of equity was 20%. Here we don't know. Cost of debt in case of unlevered firm was not applicable. But in case of levered firm, cost of debt is 15%. So cost of debt is 15%. That is obviously before tax cost, right? Overall cost of capital, here it is going to be 20%. Here we don't know. The company's earnings before is going to remain constant in the future years. The company also has a policy to issue entire earnings as a dividend. Now we want to know after the change in capital, that is after the company has become a levered entity, what will be the market value of the company, overall cost of capital, and cost of equity. So let's just work on this unlevered firm. Since we know cost of equity is, or cost of overall cost of capital is 20%, we can actually start building up the EBIT portion, right? Because EBIT is going to be simply value of firm into KO. Value of firm is 1750 into KO is 20%. So how much is going to be the unlevered value? How much is going to be the EBIT value for the unlevered company? EBIT value for unlevered company. How much is it going to be? Value of firm, which is 1750 multiplied by 20%. That's going to be 350. That will be 350. From that, we will subtract interest. How much is the interest that we are going to subtract? How much is the amount of interest? Not applicable, sir. So we get a profit before tax of 350. From that, we are going to subtract tax at the rate of 30%. So what's 30% of 350, guys? 30% of 350. 30% of 350, 105, right? 30% of 350, that's 105. Then we have profit after tax to be 245. Now since we have profit after tax and we have the income statement ready before us, when we look at the levered firm, if you change your capital structure, is EBIT going to change? If you change your capital structure, is EBIT going to change for the business? If you're going to change the capital structure, Will the EBIT change for the business? No, EBIT will remain same, but what is going to change is the interest one. So interest will be like value of debt, which is 275 into 15%, right? So 275 into 15%. How much is the amount of interest? How much is the amount of interest? 41.25. So what's the PBT? 350 minus 41.25, which is 308.75, right? So that's 275 into 15%, 41.25. From that, you're going to subtract tax, 308.75 into 30%, which is 96.63. So what is the profit after tax that we have? So 308.75 minus 96.63, which is 212.12. Right? 212.12. That's your profit after tax. Now we know that value of firm is 1750 is. We know that the value of firm is 1750. That's for levered entity. That's for unlevered entity. Now, when you want to calculate the value of for firm for levered entity under with taxes model, do you remember the formula? Value of levered will be value of unlevered plus debt into tax rate. Value of levered will be equal to value of unlevered plus amount of debt into tax rate. So that is simply going to be like 1750 plus whatever is the amount of debt, which is 275 into tax rate of 30%. So 1750, 275 into 0.3. So 82.5 plus 1750, which is 1832.5. 1832.5. That's the value of the firm, which is 1832.5. Right? Value of firm has been arrived at 1832.5. Now, once we have got the value of firm, can you tell me how do we get the value of equity for the levered entity? Once the company becomes a levered entity, can you tell me how are we going to calculate the value of the equity? Can you tell me how are we going to get the value of equity in this case? Hmm? How are we going to get the value of equity? We know the value of the firm, value of the business is known by us. We want to know what will be the value of the equity. How do we get the value of equity? Tax will be 92.63. So this difference 308.75 into 30%. Oh yeah, 90. Correct. This will be 92.63. So this is going to be different. 308.75 minus 92.63, which is 216.12. Yeah. Yeah. So how do we get the value of equity, guys, over here? If you know the value of the firm, how do you get the value of equity? Can I say from this value of firm, we are simply going to subtract less value of debt. Value of debt is 275. So if you subtract 275 from the entire firm, if you are going to subtract 275, whatever is left out, that is value of equity. So 1832.5 minus 275, that will be 1557.5. is the value of equity, right? That's the value of equity. Now we have the value of firm, we have the value of debt, we have the value of equity. So we have like got what's the value of equity, we have got the value of firm. Now it's time for us to calculate the value cost of equity and overall cost of capital. How do we go about calculating cost of equity? Cost of equity can be computed as what, guys? PAT upon value of equity, right? So here it is going to be PAT, which is 216.12 divided by value of equity is 1557.5. So cost of equity is 216.12 divided by 1557.5. That is 13.88%. One second. There is something problematic. One second. So overall cost of capital was 20%, and we said that the value of the firm is, wait, current market value of the company is 1/7, its cost of capital as 20%. So 1750 into 20% is 350. And its cost of capital is 20%, na guys? We had a mistake. We did a mistake, guys, over here. Wait, there is a mistake because we didn't look at the uh, taxation part. So EBIT, I cannot simply take value of firm into KO. Rather, we did need to do some sort of reverse calculation, guys. Just wait. Let me just remove this thing as tidy. Just wait. I'll just solve it again. Wait. One mistake can destroy it fully. Anyways, so since we have the number given over here of 20% with its cost of capital as 20%, so the cost of capital is actually cost of debt is not applicable. We know the cost of equity is 20%, so we actually need to start with profit after tax, guys. So profit after tax is going to be value of equity multiplied by cost of equity. Since we had this formula, right? Value of equity is PAT upon K. So if I want PAT, I just need to multiply value of equity with K. So PAT will be value of equity into K, value of equity into cost of equity, that is 350. From PAT, I need to arrive at EBIT. So from PAT, I need to arrive at EBIT. So PAT plus tax will give you PBT, right? And that PBT is same as your EBIT because there is no interest. Now 350 is the PAT number. Tax rate is, guys, 30%. So tax rate is 30%. So we definitely say that if your PBT is 100, this is 30, this should be 70. So now can you tell me what will be the amount of tax and PBT? Can you tell me what will be the amount of tax and PBT? Yep. So it will be like 350 divided by 70%, which is, the PBT will be 500, and this is going to be 150, right? Yeah. So now this PBT or EBIT will be replicated over here, and from this we are going to subtract interest to get at PBT, then you subtract tax to get profit after tax. So 500 is the amount of PBT. From that you subtract the interest. Interest will be 15% of 275. 275 into 15%, which is 41.25. Okay, so interest is 41.25. So we get the PBT by subtracting from EBIT, right? So out of 500, we subtract 41.25, which is 458.75 is the amount of PBT. Now from obviously that PBT, we need to subtract tax. Right? Tax is at the rate of 30%. So what's the amount of tax, guys? What is the amount of tax? 458.75 into 30%. So the tax will be 137.63. So we get a PAT of 458.75 minus 137.63. 321.12. This is the amount of PAT which will be applicable for levered entity. Okay. Now we know the value of firm over here is 1750. Here the value of firm will be 1750, which is the value of unlevered, plus value of debt into tax rate, plus amount of debt is 275 into tax rate is 0.3. So what is the value of this levered entity, guys? What is the value of the levered entity? 275 into 0.3 plus 1750. Value of levered entity 1832.5, right? Perfect. So we got the value of firm. From that you subtract the value of debt. There is no debt over here, but here there is a debt of 275. So we get value of equity all as 1750, and this minus 275 is 1557.5. So value of equity is 1557.5. Now since we know this value of equity as 1557.5, value of firm minus value of debt is 1557.5. Now we can talk of KE. KE will be PAT upon value of equity. So here the PAT is 321.12 divided by K, value of equity is 1557.5. So 321.12 divided by 1557.5, which is 20.62%. That's your K. Then we want the overall cost of capital also, KO. KO will be computed as EBIT into 1 minus T upon value of firm. So we need to do the EBIT into 1 minus T because it's overall cost of capital. EBIT 1 minus T will be applicable. So EBIT will be 500 into 1 minus 0.3, right? Divided by value of firm, which is 1832.5. So 500 into 0.7 divided by 1832.5 is 19.09%. That's the overall cost of capital. So K is 20.62 and weighted average cost of capital is 19.09%. Are you getting this? Are we good with this, everyone? Is this question and solution clear to everyone? And would you like to solve one more such question? I'll share one more such question. Will you be able to solve it in the similar lines? Yep. Will you be able to solve it on similar lines? Yeah. Okay. Let me just give you one question for you to practice on the similar lines. Okay. Try out this question now, which is very similar to what we have done right now. Yeah. Try out this question, guys. Try out this question, guys. You should be able to solve this. This is very much similar to the previous question. If you want, you can just take a screenshot of this and then you can show you the next question so that you can solve it. I hope you would have taken it. Now, try out this question. Just 3 more minutes and then I'll start with the solution. Meanwhile, we just try to attempt this. Okay, let me start with it. So this company, like the previous one, it's a all equity finance. So this is a unlevered company. So we have a unlevered company with a market value of 25 lakh. Equity shares are value. The value of equity is 25 lakh, and the cost of capital is 21%. So value of debt, it's not applicable. Value of firm will be 25 lakh. Value of debt will be anyways zero, right? And then we have cost of equity is 21%. The company wants to buy back shares worth 5 lakh by issuing and raising 15% perpetual debt of the same amount. So as it becomes from unlevered to levered, the value of equity is going to be, something which is not known, but value of debt is going to be 5 lakh. We don't know the value of firm. Cost of equity, again it is something which we don't know. Cost of debt over here, that's not applicable, but for levered it is 15% cost of debt, and this is obviously before tax cost of debt. This is a cost of debt which is before tax cost of debt. Okay, so we have the cost of debt 15% given. Now, rate of tax may be taken as 30%. After the capital restructuring and apply model, you are required to calculate market value of RES Limited, cost of equity, and weighted average cost of capital, and then obviously we need to comment on it. Okay, so now since we have this cost of equity as 21%, we start with calculating profit after tax. Profit after tax will be value of equity into cost of equity, right? So that's like 25 lakh into 21%. How much is the PAT, guys? What is the value of profit after tax? Profit after tax, value of equity into cost of equity. We are computing it as value of equity into cost of equity. What will be the PAT figure? Yeah, 5,25,000. Perfect. So this is 5,25,000. So I need to add back tax to come at profit before tax, and we need to add the tax to come at profit before tax, which is also going to be equal to EBIT in the first case, right? So what is the value of tax and profit before tax? What's the rate of tax given? Rate of tax is 30%. So by adding tax, what is the amount of PBT? So 5 lakh 20. You can simply say that this is 100, tax is 30, so PAT is 70. Right. So tax should be 2,25,000, and then profit before taxes, we add up all of them, 7,50,000. Right. Okay. This same PBT or EBIT will be applicable as EBIT to the levered firm. So levered firm will have a EBIT of 7,50,000. From this, we are going to subtract interest, which will give us profit before tax. Again, we'll subtract tax, which will give us PAT for the levered entity. So this is going to be interest. Interest will be 5 lakh multiplied by 15%. 5 lakh multiplied by 15%. How much is the interest? 75,000. So PBT is 6 lakh 75,000. Tax will be calculated at the rate of 30%. So 6 lakh 75,000 into 30%. How much is this? 2 lakh 2,500 divided by PAT. I mean, when you subtract tax from PBT, how much is the PAT? How much is the PAT? 4 lakh 72,500. So we got the profit after tax. Now we can get the KE. Before KE, value of firm. So value of firm for the unlevered it is 25 lakh. But when we want to look for the levered firm, we can apply the same formula. Value of unlevered plus amount of debt into tax rate. So value of unlevered is 25 lakh plus debt is 5 lakh multiplied by a tax rate of 30%. So 25 lakh plus 5 lakh into 30%. How much will be the value of the levered firm? What will be the value of the levered firm, guys? Hmm? What is the value of levered firm? Value of levered firm. 26 lakh. Value of levered firm is 26 lakh 50,000. Perfect. Then what about cost of equity for the levered firm? That is going to be PAT upon value of equity. So of course, since we have got the value of firm, I need to subtract the amount of debt. Subtract the amount of debt. Debt is going to be like 5 lakh. So 26 lakh 50 minus 5 lakh, which is debt. That's equal to value of equity. So value of equity will be 21 lakh 50,000. Value of equity is 21 lakh 50,000. So value of firm 26 lakh 50. Debt is subtracted. Value of equity is 21 lakh 50,000. Can we get the cost of equity? Yes, we can get the cost of equity as what? PAT upon value of equity. So PAT is 4,72,500 divided by 21 lakh 50,000. 4,72,500 divided by 21 lakh 50,000. How much is this cost of equity? 21.98%. 21.98%. So value of equity is 21 lakh 50. Cost of equity is 21.98%. Okay. So what all things are required? We got the market value of RE shares. We got the cost of equity. Now weighted average cost of capital. Now I can calculate the weighted average cost of capital as EBIT into 1 minus T upon value of firm, which will be computed as value of, EBIT is anyway 7 lakh 50. 7 lakh 50 into 1 minus 0.3 upon value of firm is 26 lakh 50,000. How much is this? Overall cost of capital, guys. What is the value of KO over here? Yep. How much is this? 19.81%. Okay. So by the way, with this overall cost of capital, we can compute it by a different method also, by using weighted average cost of capital. So even that method will be, okay to calculate this 19.81%. So we can say this is calculation of KO, or weighted average cost of capital. See, we can write it like this: capital cost value, then we give the weightage, and then weights into cost. So we have like debt and equity. Equity has got a cost of 21.98%. We got it from here, 21.98%. What will be the cost of debt, by the way, guys? I can write on the values, by the way. Values is like the value of debt is 5 lakh and value of equity is value of equity is 21 lakh 50,000. Total it is 26 lakh 50,000. That's okay. But what will be the cost of debt that I'm going to write over here? If I want to compute KO, let's say by WACC method, what is the cost of debt that I'm going to write? Can I write the cost of debt to be 15%? No. We'll have to make it as an after tax. So it's going to be like 10.5% after tax. How is this after tax? It's like 15% into 1 minus 0.3. 1 minus 0.3 to make it after tax figure, right? So if you take this as like 10.5%, take the weights and then calculate the weighted average and just see if you're getting the same 19.81 answer. Just check if you're getting the 90, same 19.81%. Just check if you're getting the same answer. Just carry out the weighted average thing. Same. You're getting the same? Yes. So weightage will be like 5 lakh upon 21 lakh 50. 5 lakh divided by 26 lakh 50,000. 0.1887 and 21 lakh 50,000 divided by 26 lakh 50,000, which is 0.8113. 10.5 into 0.1887, which is 1.9814, and 0.8113 multiplied by 21.98 is 17.8324. 1.9814 plus 17.8324. That's 19.81%. Yes, that's the same thing. Okay. Now, so we've done a couple of questions. We have still the Modigliani-Miller arbitrage model, pending to be discussed, but I'm not taking it up right now. I don't want to hurry it up. So we'll have a sufficient amount of time tomorrow also, because I'll be starting with leverages. So initially we'll be discussing, like the capital structure theory, two concepts that are left out, which is the Modigliani-Miller arbitrage model. And then after that, we will be taking up, the next session. I mean, the next topic, which is leverages. So right now, I'll just stop here. I'm just opening up for any queries that you guys have, or else we'll just call it a day. For weights, Manjari is asking for weights till 2 decimal points will be fine. No, weights generally you should take up to 4 decimals, Manjari. Okay. Any other queries, guys? Any queries you have, guys? You are free to unmute yourself or raise your hand. I'll allow you to unmute, and then we can take your query and then resolve it accordingly. Any queries? Any queries, guys? No queries? Edition May 25 relevant for 2025 or Jan 26 material. You will get the respective material in due course. Right now, just stick to whatever the edition is being stated in the material. Okay, use the latest material. That is what I can, actually recommend you. Okay, so with that, let's just call it a day, guys. Let's just stop here for the day. No other queries from your end. So let's just stop here. See you tomorrow again. We'll complete this topic in next session, and then followed by the topic of leverages, which will spill over to next Friday. Okay, so let's just stop here. Bye bye, guys. Good night.
Good night, sir.